Joining us now is Richard Fisher, former Dallas Fed president and a CNBC contributor. Richard, good to see you.
Thank you, Melissa.
And
good to see you.
Yeah, happy St. Patrick's Day. You got your green tie on there. I want to go right to what Steve was raising just moments ago, and that is the Fed going from a preactive or proactive Fed to a reactive Fed. How important is this, if it is important, and is there a danger to this?
It is important, and there is a risk here because you have to remember it takes a while for monetary policy to work its way into the real economy. I'm not talking about market reaction. And if you are reactive, first of all, data is out of date by the time you get it, even though we're getting better at getting contemporary data. If you are reactive, it's going to take time to work into the economy. And I think that's the risk, rather than anticipating and using your judgment going forward as to what's likely to happen. If, let's say, the bond market, I agree with what's been said so far. I think the market determines the 10-year rate. If they begin to price in some inflationary pressure, the Fed then does its work, gets its data, finds out there is more than transitory inflation at play, then they have to tighten or whatever they need to do. It takes a while to work its into the economy, and it'll therefore be, I think, less effective, or at least that's a risk that they're running, to answer your question. One quick point, Melissa. I noticed when Steve asked his question, that was the one time during this press conference where Jay Powell was super relaxed, super confident. He looked down, he read the answer. He anticipated the question. They're not going to deviate one iota in saying that kind of response. Lael Brainerd did it a week ago at the Council on Foreign Relations in that open meeting she had. They're reading the answer because it shows how sensitive they are to market reaction.
Hey, Richard.
Karen, let me ask you something about inflation.
Yeah.
There's a lot of talk about transitory inflation and how far they would let it go, and but coming back ultimately to this 2%. So how far do you think they would let it go before they felt a need to do something?
I don't know, and he wouldn't answer that question, but here's the problem. If you're a supply-side economist, you're also thinking about the kind of cost pressures that are now underway, raw materials, freight, I can go on and on and on. However, a business operator also has to worry about other new costs that are going to be imposed by higher taxes, perhaps unionization, minimum wage efforts, et cetera. So on top of what they're already seeing, they are likely or possibly going to price in a reaction. And it's very rare in my experience to have businesses price in an increase and then take it back. So he's right in terms of compared to the low levels at which we were a year ago. But the problem is it's the dynamic of going forward and how do businesses react. So that'll determine how transitory it is. I think what the market is doing, particularly the 10-year and the 5-year onward, is questioning that premise. Will we have transitory inflation, or will it become more embedded? This isn't 4 or 5% inflation. I'm just saying above the 2+ level, which he won't articulate, and I understand why he won't. But you could build in a behavioral reaction here, and then they have to take the time to respond, and it takes time for that to work its way through the economy, which means it could feed into itself. That's the point I'm trying to make. Still with me?
Richard, I just want to ask you this.
There's two Steves on the panel, so apologize for that. Leisman, go ahead.
Okay, I actually want to throw this out to Richard, but also to everybody, if it's okay, because here's the deal, I think. When we talk about this preemptive versus reactive thing, Richard, isn't the Fed that hasn't decided, look, we were preemptive before, and we never got to our 2% threshold. Now we're going to be reactive because we don't want to stop the market and that inflation from happening. But that changes the dynamic for the bond and the stock market. Before, it was like you had the Fed out front, kind of whacking the weeds so you could walk through the forest. And now the Fed's not there. The Fed is saying, we're behind the curve on this. We are not going to protect you from this inflation thing because we want it to get back up. So it changes the dynamic for investors while at the same time they're changing the whole policy outlook here.
Yeah, the end point is 2%. He made that clear. You see it in every dot plot. It always comes out at 2%. They don't want to see it run above that significantly for long. But again, it's really a question of whether or not they have the kind of control What I'm more interested in, though, is how the market perceives this. And what we've been saying is started out in this show. The way the market has been pricing bonds from 5 years out has raised doubt as to whether or not they actually can control things to the extent they would like to. That's my point.
All right, gentlemen, we got to leave it there. Great discussion. Thank you, Steve Leisman. Richard Fisher, thanks to you, and let us wish you a happy birthday in advance. Tomorrow is, as I understand it, your 72nd birthday, so happy birthday to you, Richard.
The odometer clicks 72 tomorrow. Thank you so much. I really appreciate it.
Good to speak with you. It seems, Tim, that the more dovish Jay Powell gets, it allows the bond market to go higher in yields on the 10-year.
Without question. And five-year inflation break-evens are at 13-year highs. And so we've all just gotten done saying he can't control the long end. The question is, how is the Fed measuring inflation the way the market is? In other words, what's the Fed think about what the market's doing with inflation right now? And does the Fed have a view on absolute levels of the 10-year, not as it relates to equity performance, but relative to their overall construct and relative to where we were going into the pandemic? And again, I just think, I know the labor market's the most important thing, but I think the dynamic of saying 4.5% at the end of 2021 still isn't good enough, along with three conditions that have to be met when they haven't met any of these conditions on inflation in the past. That, to me, reiterated today, three conditions is extraordinary.
One thing that Richard Fisher said struck me in particular, and that was when companies pass on price increases, they rarely take it back. So this notion of transitory inflation, can it actually be transitory? Just today at a Bank of America conference, we heard 3M say that costs for everything from materials to labor to logistics were 2 times more than they have anticipated. And so what does 3M do? We don't know yet. But if they pass on that price increase, Guy, you think they're going to take it back when materials come back down, when labor comes back down? I don't know.
Yeah, and I'm sorry about the dogs. That's the rhetorical question of all time. You know the answer. The short answer is no, they won't, because they'll condition people to pay those prices, and then when prices do come down, they'll leave them be, and then they'll be able to raise the next time around. So transitory to me, I don't want to use a bad word on this show, but you know what, it's a BS thing completely. So there's nothing transitory. Inflation is here. I think the Fed understands that, and the fact that they can say on one hand that they're data dependent, and on the other hand say they're not going to raise rates until 2023, to me, is mystifying and maddening at the same time.
Shepard Smith here. Thanks for watching CNBC on YouTube.